Good morning all, welcome to our webinar. We'll just give everyone a moment to join the Zoom. As our numbers roll up through 200, we'll just give everyone 1 minute. Okay, well good morning and welcome to our Markets Update webinar on the 29th of January. My name is James Sheehan. I look after the national interest rates, FX and commodities risk advisory business here at NAB. Our team is talking to thousands of NAB business banking clients with needs that include trade and working capital, foreign exchange risk, interest rate risk and transactional banking needs, helping them to navigate and mitigate the various risks they face day to day in operating trading businesses. There's a lot to talk about in our Markets Insights discussion today. Recent employment data and the inflation data from yesterday has increased the view that the RBA will increase the official cash rate next week. This is a big shift in the cycle as the RBA uses its only lever to try and curb stubborn inflation. NAB is predicting the RBA will hike rates next week, and we'll dive into the conditions supporting this view and the cycle. During this period also, we've seen the Aussie dollar shift from its slow grind higher out of the range and break 70. We'll also talk about the NAB house view on FX and what customers need to look out for. Today I'm joined by two guests. We'll hear firstly from Taylor Nugent. Taylor is a senior economist within the Global Markets Research team here at NAB. He provides economic and markets insights for our clients with a focus on the Australian economy, labour markets and inflation. Taylor studied economics at ANU and began his career at the Reserve Bank of Australia, where he worked as an economist and a financial markets analyst. One place you can hear Taylor regularly is on the Morning Call podcast. We'll show you more about how to subscribe to this podcast if you don't already. Morning, Taylor.
Good morning.
Also joined by Shane Ditcham, who's State Business Banking Executive, Metro New South Wales. Shane has been with NAB Business Banking since 2010 in a couple of stints in various roles within our business banking division. Shane's team of bankers are located where you are, in locations such as Hurstville, Chatswood, Bankstown, Penrith, Sydney CBD and the newly created Business Banking Centre servicing the growing region of Badgerys Creek. Good morning, Shane.
Thank you, Jack.
Okay, so Taylor is going to give us an update on market conditions and help us to interpret the RBA cycle. As always, we encourage people to put questions in the chat as we go. I've got the chat here live, and if we ask questions that are relevant, we'll try and answer them as we go. The update is designed to be short and sharp, and we get out in 30 to 35 minutes. If we don't get to your question, we'll endeavour to follow up with you afterwards. Over to you, Taylor.
Thank you very much. So some slides coming up on the screen now that I'll speak to. There's obviously no shortage of things to talk about at the moment. The global backdrop is, still very much ever present. It's noisy. It is, not just something that we can take for granted, a kind of benign international environment that remains very much in play. We'll touch on that a little bit more later as we talk about the labour market the exchange rate in a little bit more detail. But I want to start today focusing on the domestic cycle and where we are, because that's what's driven the RBA repricing over the last 3 to 6 months, and that's what the RBA is focused on as they think about the path forward over the course of 2026. Where we are at the moment is, there is no shortage of good news is one way to look at it when we look at the growth cycle. We had a period of slow growth coming out of the pandemic as we rebalanced from what was, obviously an overheated economy. Businesses were seeing capacity constraints, inflation was much too high. We had a grinding rebalancing process that into, early 2024. We've seen growth start to pick up from late 2024, and we've seen that continue. And this is a positive story. You can see on this chart here that alongside this pickup in domestic demand and economic activity more broadly, there's also been a bit of a mix shift. Rather than it being public sector growth that was, plastering over some weakness and the adjustment that was being felt through the private sector and through households especially, we've seen that pivot, and it's now private sector growth that's actually driven a lot of the economic performance over the last 12 months or so. A big part of this is consumption. Consumption growth has been stronger. Household income growth has been stronger. But also a big part of it has been business investment as well. So, some of that is coming through in, what we hear about and read about more and more every day in terms of data center investment. That's certainly evident, but it has been a broader story than that through private demand as well. So it's an encouraging sign that growth is picking up. A challenge, of course, is that it's picking up at a time when inflation, had really only just started to put in numbers that were around where the RBA wanted to see it. And it's picking up from a base that doesn't reflect spare capacity in the economy. And so that's something that I'll unpack a little bit more in a moment. On that growth story, to get into that in a little bit more detail, it really has been households in Australia that are kind of the tip of the spear in that rebalancing that we saw over the past few years. We saw during 2023 that household incomes on an inflation-adjusted basis were falling. And as a result of that, discretionary consumption was especially weak. So what we saw, what was the driver of that? Well, in a higher inflation environment, real income taxes are going up because tax brackets aren't linked to inflation. With inflation outpacing wages growth, inflation was a big drag on people's real wages. And we also have the RBA in a tightening cycle. And so mortgage servicing costs were part of this story as well. All of those things were moving in the other direction over the past year or two. And we've seen a return to real wages growth, an end and some cuts from the RBA, and we saw the stage 3 tax cuts coming through as well. And so that income dynamic turned much more positive, a return to real income growth, and we saw that flowing through into a pickup in consumption growth as well. Some of those tailwinds for households are fading. Those tax cuts are getting further and further in the rearview mirror. The deceleration in inflation has stalled. And as we'll talk about, we do think that the RBA easing is done, and they will probably be reversing course over the first half of this year. But that doesn't necessarily mean that things are, really turning a corner sharply for households and for growth and for the household consumption outlook as well. One reason for that is alongside this pickup in household income growth that we saw, we also saw a normalization in household savings. And so people were taking some of this improvement in income growth, saving part of it, increasing spending with another part of it. But when we look at savings rates now, those are back a little bit above where they were prior to the pandemic. And so what that means is looking forward, while income growth may not be quite as strong as it was in that, the recent rebounds, a lot more of that is going to translate through into consumption. And so we're still reasonably optimistic about the outlook for household spending growth, and that's supporting our expectations for GDP growth to be somewhere near trend, around 2.25% over the course of 2026. I mentioned, though, that while the kind of pickup in growth is a good news story, it's not something that the economy and that the RBA is necessarily in a position to celebrate on its own. And the reason for that is that the starting point was an economy that was near balance, or maybe even still a little bit tight. And so that's a big theme in what's kind of driven this repricing of RBA expectations that we've seen over the past 6 months. Some pickup in growth was kind of always expected. It was always in our and others' forecasts. But what we've seen is that that pickup in growth, especially on the household side, has probably been a little bit stronger than anticipated. Another is that it's found capacity constraints in the economy a bit more than we might have expected. And so we've seen that reflected in some stronger inflation outcomes than were earlier anticipated. One area to kind of look at this is from our NAB business survey. We can see that business conditions have improved from where they were in early 2024. They're now above their long-run averages. We got our December results earlier this week, and that essentially confirmed that some of that improved momentum that was evident, sustained into the end of the year. The other side of that, though, is, while business conditions are reasonably healthy, they're above their long-run average. You can see on that left-hand chart, they're not at exceptionally high levels relative to history. But what is elevated is what businesses are saying about their capacity utilization. And so what we're seeing is that businesses are capacity constrained. They cite labour availability as one thing that is a constraint on their ability to expand. But we're also seeing this elevated, through product markets and other areas where it's difficult for businesses to expand output too much because their utilization is reasonably high. A difference in this cycle is that we've seen this reacceleration in growth from an economy that didn't have a lot of spare capacity. There weren't a lot of idle resources on the sidelines that could be utilized to feed this growth. And that's part of the reason why it's translating into a little bit of an uglier inflation outlook than had been earlier expected. That's a bit of a contrast, to somewhere like New Zealand, for example, or Canada, where their central banks took a little bit of a firmer approach earlier in the cycle. They stamped out, they lent more heavily against earlier inflation pressures, and as a result, they're seeing a cyclical upswing from a starting point where there's spare capacity. And so central banks aren't necessarily as sensitive, to small surprises either way in terms of growth and inflation in that kind of environment.
Can I just ask you, just on the business survey, which is really interesting, the difference between conditions and confidence? What are the questions asked of businesses in that survey to produce that outcome?
So business conditions, that's really drawn up from three questions that ask businesses, what are their conditions now? And so it comes through from trading conditions, it comes through from profitability. Those two components have been what's driven the uptick that we've seen over the past 6 to 12 months as, again, that kind of pick up in demand fed through into better trading conditions for businesses. Some of this easing as demand improved, this squeeze on margins amid elevated cost pressures, that started to fade. And so we've seen profitability improve a bit as well. And the third key component of that is employment. And so employment is at reasonably healthy levels, but it certainly hasn't driven as much of an upswing that we've seen in trading conditions and profitability. In contrast, confidence really just asks businesces, how do they feel about the outlook? It is kind of a more direct measure. So in some sense, it can be a little bit more forward-looking. And certainly, it is the case at the moment that confidence, it can be volatile, but confidence is around or marginally below its long-run average. And as you can see there, has kind of come off its recent highs in, probably in no small part because of the repricing in inflation expectations and in RBA expectations that we've seen. But broadly, business confidence is not at weak levels. It's nowhere near where it was coming out of those, that very challenging profitability environment post pandemic. Even if it is a little softer than conditions are at the moment. So that point there where trading conditions, profitability has improved a little bit, but businesses are still finding it difficult to find suitable labour and their capacity utilisation is reasonably elevated. That obviously, one aspect of that is the conditions in the labour market. And what we've seen here is effectively that, unemployment has remained low. The unemployment rate did move a bit higher alongside that period of slower growth that we saw. But, at a bit over 4%, it remains well below where it was prior to the pandemic. And where we are now is that, unemployment data, James mentioned this up front last week, for the December month showed that unemployment actually dipped back down towards 4.1%. And so where the RBA, it was clear that they were conscious that there was a slow uptrend potentially visible in the unemployment rate. That's something they were a bit concerned about. That December data, while it doesn't necessarily mean that the labour market is retightening, it probably does mean that they should be a little bit less worried that the labour market is going to weaken materially in the short term as they think about that kind of balance between inflation and employment in their interest rate decisions.
So just interpreting that, people often think that the RBA focuses a lot on inflation. Just help us extrapolate that a little bit, that link between unemployment, having that tick to 4.1. Why did that lead, even though we were already calling the Fed hike, why did that lead the market to then think, okay, now the Fed hike is really on the table?
Yeah, so I think when you think about the RBA, it among a number of central banks has a dual mandate. So they have full employment on one side, they have their inflation target on the other side. Those things are kind of intricately linked. Yeah. Essentially, when we think about the RBA's inflation target, they want inflation to sustain around the midpoint of their target over time. One of the ways that they do that is they think about the domestic conditions, they think about wage inflation, they think about the outlook for growth, for households' ability to buy things and see their consumption expand. And all of those things really depend on the labour market. And so when we think about full employment, it's where essentially kind of the maximum level of employment, the minimum level of unemployment that can be sustained over time without generating inflation pressures that, cause them to miss their inflation target over the long term. And so when they're kind of balancing those, they're looking at the recent inflation data, what's momentum in inflation, what's growth doing, but also is the labour market evolving in a way that is consistent with our inflation target? If the unemployment rate's moving higher, then they're going to be revising down their growth forecast, they're going to be revising down their consumption forecast, and they're going to be comfortable that inflation will be moving down when they draw their forecasts. Yeah. And so as we kind of move towards February, I think that you saw market pricing move quite strongly, because when we look at the kind of the world of data that the RBA looks at, consumption growth was pretty good. Activity growth had been outpacing their forecasts a little bit. Inflation was concerning. It was again running a bit stronger than their forecast in the fourth quarter. But the labour market wasn't necessarily saying that this was, a labour market driven phenomenon. And so they still had one eye on the labour market, still a little bit concerned that might have been weakening. And so I think that the December data just means that, if there were voices there suggesting that maybe we need to wait, maybe we need to see what the trend is in the labour market before we move, that argument probably gets a bit weaker given what we saw in December on the recent labour market dynamic. Another thing that I think is worth touching on in the labour market as well, while the unemployment rate has remained low, it's certainly the case that vacancies have fallen quite noticeably from where they were previously, that employment growth in itself has kind of slowed a little bit, and yet businesses are still saying that they're having trouble finding labour. And I think what we're seeing there is that there's differences within the labour market, and some areas have loosened more noticeably than others. And so you can see on that right-hand chart there that if you just look at unemployment among people who were previously employed in managerial or professional occupations, so like, white-collar workers broadly defined, those people are actually unemployed at similar rates, if not a little bit higher than what they were in 2019. A lot of the rebalancing that we've seen in the labour market has come from those sorts of occupations. If you look at other areas, if you look at what I've labelled blue collar there, so this is labouring occupations, it's technicians and trades, unemployment is much less common among people who were previously employed in those sorts of occupations than what it was prior to the pandemic, and hasn't shown as much of a loosening. And so it is the case that there are pockets of the labour market that remain very tight and haven't loosened much over this period, even as there are others where there has been more noticeable rebalancing. And so that kind of context, a labour market that isn't necessarily itself kind of the driver of some of the recent strength in inflation that we're seeing, but certainly a labour market that isn't loose and isn't something that's going to make the RBA particularly comfortable that we're putting downward pressure on inflation so much downward pressure on inflation as they look forward, and a growth backdrop that's reaccelerated, seems to be finding capacity constraints, and looks to be kind of sustaining on the most recent data that we can see. That's the setup for the RBA, and then we can overlay what's happening on the realised inflation outcomes here, because it is the inflation outcomes that has driven the most material portion of that repricing that we've seen. And I put the RBA's two most recent forecasts on this chart as well. So obviously the first leg we had already seen when we delivered a similar kind of webinar about 3 months ago. Inflation in the third quarter was materially stronger than the RBA was expecting. It shifted the outlook. There were question marks over how sustained that would be. And there, what we saw was, our view was that sideline the RBA for the time being. They were on hold. But the data flow since then has, what's seen us shift late last year to thinking that a move higher in policy in the first half of 2026 is what's in order. And you can see there the data that we got yesterday. The surprise relative to the RBA's forecast, it's nothing like as spectacular as what we saw in the third quarter, but it does suggest that even with their upward revision to the forecast, inflation was still a little bit stronger than they would have liked, and showed a bit more persistence than they were expecting in the fourth quarter. And so, what does that actually mean? Kind of, if we look back 6 months ago, inflation had been coming in around the midpoint of their target bands. The RBA was, normalising policy. They were taking their foot off the brake gradually to get rates down to levels that they saw as more normal in the low threes. We saw an inflation surprise a few months ago now, see a lot of that easing expectation be taken out. The data flow since then has meant that market pricing has kind of continued to move towards our expectation of 50 basis points of tightening in the first half of this year. And you can see it is a very material shift in what markets pricing for the RBA relative to where we were previously. And so just to clarify there, I've noticed I've got H1 2025 there in the subtitle. I do mean 2026. The broader context here is, inflation is too strong, but we don't think it's accelerating away from the RBA. And we do think that, what we're forecasting here, we're characterizing it as a modest recalibration. Things were a bit tighter than the RBA expected, inflation a bit stronger than the RBA expected, policy isn't leaning it firmly enough against those sorts of dynamics. And we think that, if the RBA does move and move early, then, 50 basis points of tightening in 2026 is probably, the extent of the tightening that we're expecting to see. And if we look further out, our forecast at the moment is that if the RBA delivers as we expect, then by the time we get into, the second half of 2027, it's likely that, the RBA will be again looking to bring interest rates lower. And so our forecasts are not that a policy rate above 4% is the new normal forever. But it is the case that we don't think the current policy is restrictive enough given the conditions. And if the RBA is, proactive in leaning against that with moves in February and May, as we're forecasting, then we could be looking to, move rates modestly lower again if we fast forward a couple of years.
I've just got a question pop in. I'll come to you, Shane, in a second. But I'll pop in from Sam Sainsbury, who runs our rates business here in New South Wales. And she's asked a really good question. If you just pop back a slide about, so if we're going to have a potentially shallow is not quite the right term, but a short hiking cycle and then back into easing, what would be the risk that would change that view?
Yeah, so there are a couple of risks on both sides here. One is that, certainly in the short term, it is still the case that, the RBA has been reasonably inertial, I suppose you could say, this cycle. They've been reluctant to move interest rates too far, too fast in either direction. Mm-hmm. And so there is, the potential that they seek to hold on. They want to see, does the recent strength in inflation sustain? Does the kind of repricing that we've already seen, is that, sufficient in and of itself to see some of the momentum come out of the consumer? Essentially, kind of, they can see these evident risks on inflation, and they can see the realized inflation data is too strong. But do they kind of, try and hold on and see how the data evolves? That is the risk. One thing that we would be concerned about there is if they do try and hold on, some of these risks are realised, then it could mean a bigger cycle and a more painful adjustment later. That's the risk on that side. So from that perspective, if the RBA doesn't get moving in the first half of 2026, then it could mean a tougher job later. The other side, of course, is that our expectation is that with a little bit of policy adjustment now, with some indicators in the inflation momentum, that it's too high, but it's not accelerating away from them. It's decelerating just ever so slowly. The other risk is that, well, maybe they do need to keep going. And so, a small adjustment turns out there's more momentum in the domestic economy than we're assessing at the moment, and a modest recalibration isn't enough. So those are the risks on either side. But our central case is that it's not the case that this is the start of a massive multi-year inflationary boom. It's just that there is more pressure in the system still. We're finding capacity constraints a bit harder, and the RBA is still in a position to manage us out of this cycle without too much of a hit to growth and employment.
On that, let's go about that charts. This is an amazing slide, really. I think for everybody who's enjoyed today. But for reflect on some of the conversations that we have with bankers, leaders, and businesses, we've already called out, Taylor, the labour and capacity. I think that's been prominent for a little while now, and obviously looks like it's going to continue for a little bit yet. But what's elevated is the conversations around interest rates and the movement, and you've illustrated it really well here. You look at that forecast 6 months ago, it changed to 3 months ago, changed to latest, and you've added that extra colour about even the risk to that. It's understandable business owners at the moment to think about as getting much information they possibly can to navigate through this. Mm-hmm. And that's certainly what I'm hearing there. Most of the conversations, that's where I get most of the feedback on, This is great to find this information and insights.
I was interested, Shane, and we'll look at this slide, which is really interesting, but a lot of your conversations out in metropolitan New South Wales, trading businesses, second largest cost of all those businesses is interest. How are they feeling about that then? What's been the reaction that you've seen?
I think it's that the change, and it creates uncertainty. So decisions that you can make with a bit of certainty, where you thought, okay, well, that's the forecast. And history showed you probably rely on that. I'm not sure that's the case now. Certainly, the conversation seems to suggest that uncertainty levels is up, and what's the right decision to do right now. I think that's the challenge that business owners have, and that's our opportunity, in the roles that we have, to provide as much information that you're sharing today, Taylor, on what the insights are, what the levers are, what to watch, so we can make the best decisions, or help our customers to make the right best decision they can.
And I think that, what should we be expecting over time is, it's much more challenging than it has been for a while, because there's really two themes happening here. One is that the cycle over the past few years has been, larger, more exciting, more dynamic, given the pandemic shock, given everything that's happened since then. And so those cyclical conditions can move quite quickly. But you've also got an environment in which we've had this kind of trend decline in, what we call neutral interest rates, or where rates are likely to settle. And you can kind of see that on this chart here, where interest rates prior to the GFC tended to just be much higher. They were moving lower. We saw the RBA with policy rates, around 1.5%, and moving down even prior to COVID. What we've seen since then is that pre-COVID environment is not providing the right benchmark. And so even though, our forecast is that if the RBA maybe tightens a little bit in the first half of this year, probably will be looking to some easing by the time we move fast forward a couple of years, we're not talking about easing back to 2% or 1%. We're talking about easing back, towards the mid threes. So it is a fairly small cycle there, and we're certainly not expecting interest rates to sustain at the kind of low levels that we saw prior to COVID. A couple of things to watch out for there, kind of the further out in the curve you look, we do expect some steepening pressure to continue. A lot of those themes are global. But even if you look at kind of, 3-year or 5-year swap rates here that I've highlighted, it's normal for them to sit above where policy rates are. They weren't for a long time this cycle as markets were looking towards easing. Where we are at the moment, it's pretty clear that with this repricing that we've seen in financial markets, that they're off their lows. If the RBA delivers as we expect through the first half of this year, maybe we can see these move a little bit higher from here. But yeah, so the broader story is that that anchor for where interest rates are going to settle, it's not back towards where we were pre-COVID, and there's a lot of pressures coming from offshore globally that suggest that certainly the further you look, so some steepness in curves is likely to be a theme as well. So how do we translate through into the Australian dollar? I mentioned, very briefly there some of these dynamics offshore. When we look at the currency, we have to kind of dive into that in a little bit more detail. James framed it right up front as well. The Australian dollar, our FX strategists have been pretty clear that the Australian dollar should be moving kind of up and through 70 cents as we move in and through 2026. It had been, fair to say, a fairly frustrating journey through a lot of 2025, where the Aussie was grinding higher. Every time it moved higher, it was making higher highs, but then it would kind of fall back. There's no shortage of challenges in the global backdrop that can weigh on the Aussie quite quickly. When we think about the risks that are there, the Australian dollar is and will remain sensitive to global growth expectations and sensitive to risk sentiment. That's all been a challenge. When we look at what's happened recently, a big part of this, move up to 70 cents has been a broad US dollar story. There's, these themes around the potential incentives to diversify away from US dollar assets. That doesn't mean, sell America, but it might mean that at the margin, people are a little bit, want to be a little bit less overweight US dollar investments. You've got all of these concerns about the geopolitical backdrop, the domestic political environment in the US creeping in to some risk premium for the US dollar as well. Another one to call out, of course, is the US Federal Reserve independence question, which comes up periodically. Yeah. We expect a new chair for the Federal Reserve to be announced soon. You've got the Lisa Cook firing case that the Supreme Court is in front of the Supreme Court. So there are these questions here at the moment. I think what we've seen is that, these themes have been there. They haven't gone away. They'll remain there. But we've seen, a lot of that expressed in currency markets over a fairly short period of time, I would say. And so a big part of this is the US dollar story. We don't think that this is necessarily something that is, massively overextended. We think that those themes are there, and we think that the Australian dollar was probably a bit unlucky to not be closer to 70 cents for a while. So in some sense, it's just kind of making up for, some of that undervaluation, if you like. But it's not just a US dollar story. And so when we think about the other factors that are driving the Australian dollar that's driven a little bit of outperformance on the crosses, then the RBA story that I've been through today is one of them. That repricing, the domestic conditions have certainly been supportive. And another one that's worth calling out is that we've seen the renminbi, the Australian dollar, is obviously sensitive to our major trading partner. Authorities there have been comfortable letting that continue to strengthen against the US dollar as well. And so those were really the themes that have been driving our Australian dollar view, some US dollar weakness on a broad base, some further strengthening in the renminbi, and that domestic cycle in Australia that is supportive of the Australian dollar as well. All of those things have kind of expressed themselves pretty quickly. And so it doesn't necessarily mean that, we're going to see this trajectory extend, but it also doesn't mean that, we've found a ceiling here when we look through 2026.
I think the previous one and this one, a couple of fascinating charts. And when our customers who are dialed in are thinking about risks that they're exposed to in currency and interest rates, is about a conversation with our team. And how do you mitigate those risks? How do you prepare yourself to be ready to act when, in this example, you have a shift up through 70? Have you got orders on? Have you got a strategy in place? Really important. We've got some good questions to come to. Just before we go off this slide, a question from Lucas Vaughan, who runs our Victorian FX business. Do you think we'll soon start talking about the strong Aussie dollar helping to ease inflation?
Yeah, no, it's a good question and a good point. And yes, it will help to ease inflation. I think a good way to think about this in the short term, when we think about these things that can price quickly, whether it's fuel or other things, Australian dollar against the US dollar is relevant. So that should be pretty helpful pretty quickly. Those can be fairly volatile prices, less reflective of that kind of underlying pulse. The way that the RBA often looks at this and builds it into their forecast is the Australian dollar on a trade-weighted basis. So not the Aussie against the US dollar, but the Aussie against the currencies of our major trading partners. So it's the renminbi, it's the yen that have a much bigger weight there. But what we've seen, as I mentioned before, it's not just a US dollar story. The Australian dollar has appreciated on a trade-weighted basis as well. And in fact, if you compare it to 3 months ago, Australian dollar about 4% higher on a trade-weighted basis. So that is helpful for the inflation outlook. A rule of thumb is that feeds through about kind of 10 to 1 into inflation over a couple of years. And that's the important thing. And so, as a rule of thumb, that kind of appreciation of the past 3 months takes maybe 40 basis points of cumulative inflation over 3 years or so. And so it's not necessarily something that's completely overwhelming the domestic dynamics, but it's certainly something that, speaks to what we were talking about before, where, we do expect the RBA is going to be forecasting inflation moving down towards their target. This is helpful in that, but it's not necessarily something that kind of overwhelms that domestic story that I was talking through before. So that's actually the key themes that I was looking to cover. Any other questions there, James?
Yeah, we've got a few. And thanks to Mark Robertson, who asked a question about pre-pandemic levels, and you addressed that. So glad we could sort of get to that on the fly. Before I want to ask Shane something just about February. Before we do that, there's a couple of good questions around inflation and household savings. Mm-hmm. So the first one is, when you say household savings is increasing, do we know what segment of the population we're seeing that in?
So not in too much detail on that slide. I think I just want to distinguish a couple of concepts here. When I'm saying household savings are increasing, it's the savings rate. So effectively, how much of household income is left over after consumption. And so that's not including things like capital appreciation or any of those sorts of dynamics that can be increasing wealth. It is that other dynamic. When we think about kind of what are the big drivers, you can see it through the cycle that it has been lower income households, younger households, renters that have been under the most income squeeze. And, so savings have been under most pressure there. And certainly in the consumption outcomes, what we can see is that underperformance has been narrowing.
Yep.
And so alongside this kind of pickup in growth, we've seen a bit more convergence where those segments of households that were under the most pressure they have been kind of closing that gap a little bit. So I expect that to be the case through savings as well.
Okay, great. And a question about a contributing factor to inflation, and this would be a good one for Michelle Bullock as well. Is a contributing factor to inflation driven by real estate price increase? And when are we seeing overseas investment come in? Is the policy aligned where increasing the RBA rates really means affecting borrowing local?
So I think that certainly house prices and the kind of chronic housing undersupply are very important in these dynamics that we're talking about. Capacity constraints are broader than just housing, but they're certainly there in housing, whether that's the construction industry or in rental markets. There's a couple of things to tease out here, though. When we're talking about inflation, house prices aren't in that index.
Right.
What's included in inflation is rents. Renting housing as a service. And in Australia, it's also the cost of building a new house. So that's not buying established dwellings. It's the cost, not including land, of building a house. And so both of those are strong. They've been part of the reacceleration of inflation. We expect them to continue above average inflation over the next couple of years. But it's not house prices directly that's feeding into the inflation outcomes. Where that does matter, though, and where I think it will have caught the RBA's eye, is they'll look at this both from lending, in terms of financial conditions, helping their assessment there. Is it creating any financial stability risks? And also, what are house prices doing in terms of household wealth? And is that a factor that's kind of supporting consumption and consumption growth? And so another thing that we've seen is that lending has increased. Housing lending has grown quite strongly, suggesting that maybe that's picked up a bit more than the RBA would have expected when they were easing interest rates. And you've seen that kind of, in large part led by investors, but it's not just investors. It's certainly broader based than that. And we've also seen that the very strong growth in house prices has been feeding through into consumption outcomes as well via the wealth effect. And so they're focused on from that perspective, and it's certainly a factor in their decision making. But no, house prices are not in their inflation target.
Okay. And just one last one before I want to ask Shane a couple of things. Are there any upcoming US policy, economic or Fed Reserve actions that could materially impact Australian economics and the Aussie dollar over the next 3 to 6 months?
It's a great question. We can't ignore these risks. We had the Fed last night. They were on hold as almost universally expected. So, the backdrop in the US is that they've got inflation that is too high. They've got growth that has been resilient in the US, but they've got a labour market that employment growth is very low, and Fed officials have been concerned that the unemployment rate would be moving higher. So they eased 75 basis points late last year. The message here is that they think they've got rates now at about the right level to manage these risks they're watching, and so we expect them to be on hold for a while yet. So the Fed's probably on the sidelines for the first half in terms of their policy decisions before maybe a couple of cuts from as we get deeper in 2026. That doesn't mean that there's nothing to watch for. So I mentioned that Lisa Cook case that's before the Supreme Court. That's a question of Fed independence, and so political pressure on the Fed to lower interest rates, even if the macroeconomic conditions don't support it. That's something that could easily feed through into US dollar weakness, and Australian dollar would be on the other side of that. Where we are at the moment, though, is that there are risks on both sides here. So it's important not to just think of this as one-sided risk. It could be the case that decision is out. It says that Donald Trump doesn't have the authority to fire Fed officials. We could get a pick for the new Fed chair that is credible among financial markets, and some of this kind of risk that's being priced in and has contributed to some of the weakness in the US dollar could fade away. And so there are risks there to watch. The general geopolitical environment is always going to be challenging for financial markets to price, but it's certainly not something that's gone away. And the US domestic policy as we run up to the midterms is going to be in focus as well. And I think that's where a key difference now compared to what we were talking about in kind of April, May last year is that these risks are there. There's no shortage of risks, but they feel much more two-sided.
Right.
It's less, well, there's all this uncertainty. We could get a really negative global growth outcome. There's uncertainty, and it could feed into an overheated US economy that could be running hot. It could feed into a number of things. And so, we have to pay attention, but it does feel a bit more two-sided.
True. So I am keen to just hear from you, Shane, a little bit about come post-Australia Day, and we look into February. How important is February for you and your relationship managers, and what's the outlook for that time?
Thanks. That's a leading question there, James, which I appreciate as well. It is a critical month for us and our bankers, but also for business generally. We want to be maintaining momentum into that last quarter of the financial year, but then we're also thinking about businesses are thinking about the year ahead, and the conversations that they're having about how do we navigate through some of the opportunities and challenges that we've talked about. So for February, expect all of our NAB bankers to be out in the market. We prioritise that every day, every banker out with business owners and having conversations that talk about what's important to you, what is on your mind, investments that you want to make, and then how we as a banking partner can assist. So it's a critical month, and probably no more so than this month from all the insights that Taylor has shared. And there's still a lot to play out, which can affect some of our currency interest rates that we've talked about today. And of course, that includes, you mentioned it, James, having our market and interest rate, trade and FX specialist partners joining those conversations. So if there's a message I'd like to leave with all our business customers tuned in today, that specialist advice that you've heard shared via insights from Taylor, from James and our markets teams, it's available to you. And I think about all the risks in the market at the moment, more information that you can have to help you navigate what's the right decision for you and your business going forward. Going to be a good thing, so please tap into it.
Yeah, terrific. And look, as a link to that, I mentioned it off the bat, the Morning Call podcast, and we produce a podcast, the research division daily, comes out first thing in the morning, goes for approximately 10 to 15 minutes. It's a short, sharp way to take in information, what's happened in financial markets overnight, where a lot of the key levels are, Aussie dollar against many cross currencies, interest rates. You can search for it, just Google NAB Morning Call, and you can find the Morning Call podcast. Great way to take in information, and you regularly hear from Taylor, who's provided some great insights today. So we are going to leave it there. I'd love to thank Shane for his time and his input, and Taylor for the fantastic insights. And look out for our next webinar, which will be upcoming soon. Thanks, everyone, for your time.
Thank you.
Thank you.